I want to share something important about market crashes and how regular people like you can use them to build real wealth. 5F understanding market crashes. Let me start with a simple truth. Market crashes are not your enemy. They are your opportunity. I've been investing for over 70 years, and I've seen many crashes. The crash of 1973, 1974, Black Monday in 1987, the dot-com bubble in 2000, the financial crisis in 2008, and the COVID panic in 2020. Every single time people panicked, every single time that panic created opportunities. You see, a market crash is like a big sale at your favorite store. Imagine walking into a store and seeing everything marked down 30%, 40%, or even 50%. Would you run away screaming? No, you would fill your shopping cart. But when stocks go on sale during a crash, most people do the opposite. They sell everything and run away. This makes no sense. Why 2026 could bring opportunities now. I'm not predicting a crash in 2026. Nobody can predict exactly when crashes will happen. But I can tell you this, crashes happen regularly. They are part of the market cycle. Whether it's 2026, 2027, or any other year, another crash will come. It always does, and when it comes, you need to be ready. Papi, my philosophy, be fearful when others are greedy. I have a famous saying, be fearful when others are greedy, and greedy when others are fearful. This is the whole game right there. When everyone is buying stocks and prices are going up and up, that's when you should be careful. When everyone is selling in panic and prices are crashing down, that's when you should be buying. Think about it this way. If you wanted to buy a house, would you want to buy it when 10 other people are bidding against you and driving the price higher? Or would you want to buy it when the seller is desperate and willing to take a low price? The answer is obvious. But in the stock market, people forget this simple logic. Building your cash reserve. Now, here's what you need to do right now before any crash happens. Build up cash. I know this sounds boring. Cash doesn't give you exciting returns, but cash is ammunition. Cash is power. When a crash comes and stocks are on sale, you need money to buy them. Berkshire Hathaway, my company, often holds billions of dollars in cash. People sometimes criticize me for this. They say, I'm not putting that money to work, but I'm waiting. I'm patient. When the right opportunities come during a crash, I want to have plenty of cash to take advantage. You should do the same thing on your level. Start saving money now. Cut unnecessary expenses. Build an emergency fund first. At least 6 months of living expenses. Then, beyond that emergency fund, save investment cash. Keep it in a safe place like a money market fund or savings account. This money is not for emergencies. This money is for opportunities. 5A understanding what to buy during a crash. Not everything is a good buy. Some companies deserve to have lower prices because they have real problems. You need to know the difference between a good company having a temporary problem and a bad company having a permanent problem. I look for businesses that are simple to understand. If you can't explain what a company does to a 10-year-old, you probably shouldn't invest in it. I look for companies with strong competitive advantages. I call this a moat around the business. Just like a castle with a moat is hard to attack, a business with competitive advantages is hard for competitors to destroy. I look for companies with good management, honest people who treat shareholders like partners. I look for companies with strong finances, businesses that make good profits and don't have too much debt. And most importantly, I look for companies that will still be around and doing well in 10, 20, or 30 years. Probably the power of great companies. Let me give you examples of businesses I love. Coca-Cola. People have been drinking Coca-Cola for over 130 years. They will probably still be drinking it 130 years from now. American Express, people trust this brand for their financial transactions. Apple, people love their iPhones and iPads. These are simple businesses with powerful brands. During a crash, even these great companies will see their stock prices fall, not because the businesses are failing, but because people panic and sell everything. This is your opportunity. When a great business that normally sells for a high price suddenly becomes cheap, that's when you buy. Dollar cost averaging during the crash. Now, here's an important strategy. Don't try to buy everything at once. Don't try to catch the falling knife, as they say. Instead, buy in stages. This is called dollar cost averaging. Let's say you have 10,000 saved up to invest. Don't invest all 10,000 on the first day of the crash. The market might fall 20% and then fall another 20%. Instead, invest 2,000 now. Then wait a few weeks and invest another 2,000 and so on. This way, you spread out your purchases and get different prices. This strategy does two things. First, it protects you from buying too early when prices might fall further. Second, it keeps you calm and disciplined when you have a plan to invest steadily. You don't panic about daily price movements. Ignoring the noise during a crash, the news media will be full of scary headlines. Fall, investors lose billions, or worst crash since 1929. Turn off the news. Stop checking your portfolio every hour. This noise will only make you emotional and cause you to make bad decisions. I don't pay attention to daily stock prices. I don't care if the market is up or down today. I focus on the businesses I own and whether they are performing well over the long term. You should do the same. Remember, the stock market is a voting machine in the short term, but a weighing machine in the long term. In the short term, prices go up and down based on emotions and panic. In the long term, prices reflect the true value of the businesses. Parfait, the importance of patience. This is perhaps the hardest part. After you buy stocks during a crash, you need to wait. The recovery might take months or even years. You cannot expect to buy stocks on Monday and sell them for a profit on Friday. When I buy a stock, I plan to hold it for at least 5 to 10 years and often forever. I'm buying a piece of a business, not a lottery ticket. I want to own that business for a long time and collect my share of its profits. During the 2008 financial crisis, I invested $5 billion in Goldman Sachs and $3 billion in General Electric. People thought I was crazy. The market kept falling for months after I invested, but I was patient. I knew these were good companies that would recover, and they did. Berkshire Hathaway made billions from these investments. Avoiding common mistakes. Let me tell you what not to do during a crash. Don't panic and sell your good stocks. Don't invest in things you don't understand just because someone says they're the next big thing. Don't use borrowed money to invest. Never invest with money you can't afford to lose. Don't try to time the exact bottom of the market. Nobody can do this consistently. Also, don't chase hot tips or guaranteed returns. If someone promises you huge returns with no risk, they are lying to you. Every investment has risk. The key is to take smart risks with good businesses at good prices. Pay the tax advantage. Here's something many people forget. When you hold stocks for a long time, you pay lower taxes in the United States. If you sell a stock within 1 year, you pay higher short-term capital gains taxes. If you hold for more than 1 year, you pay lower long-term capital gains taxes. Better yet, if you never sell, you never pay capital gains taxes at all. I've held some stocks for over 30 years. The value has grown enormously, but I haven't paid a penny in capital gains taxes because I haven't sold. This is the power of long-term investing. Index funds, the simple solution now. Maybe you're thinking, Warren, I don't have time to research individual companies. I'm not an expert like you. That's okay. I have a simple solution for you. Buy low-cost index funds. An index fund owns a little bit of every company in an index, like the S&P 500. This gives you instant diversification. You own pieces of hundreds of businesses. And here's the best part. You don't need to pick individual stocks. You just own the whole market. I've said many times that most people should just buy an S&P 500 index fund and hold it forever. During a crash, these index funds will fall just like individual stocks. But over time, they will recover and grow because the American economy grows. In my will, I've instructed that most of the money I leave to my wife should be invested in a low-cost S&P 500 index fund. That's how much I believe in this strategy for regular investors. Starting small is fine. You don't need a lot of money to start investing. Even if you can only save 100 or 200 per month, that's fine. Start where you are. The important thing is to develop the habit of saving and investing regularly. Over time, small amounts add up. If you invested 200 per month for 30 years and earn an average return of 10% per year, you'll have over $450,000. That's the power of compound interest, what Albert Einstein called the eighth wonder of the world. If I'm learning continuously, I spend about 80% of my day reading. I read annual reports, business newspapers, and books about businesses and investing. You don't need to read as much as I do, but you should keep learning. Read books about investing, learn about different businesses and industries, understand basic financial concepts like profit margins, return on equity, and debt ratios. The more you learn, the better investor you'll become. Some books I recommend are The Intelligent Investor by Benjamin Graham, my mentor. This book teaches you value investing, buying stocks that are worth more than their price. I also recommend Common Stocks and Uncommon Profits by Philip Fisher. 5-Phase staying disciplined. The biggest challenge during a market crash is staying disciplined. Your emotions will tell you to panic. Your friends will be panicking. The news will be full of doom and gloom. You need to stay calm and stick to your plan. Write down your investment plan now before the crash. Decide how much cash you'll keep ready. Decide what you'll buy during a crash. Decide how you'll spread out your purchases. When the crash comes, follow your plan like a robot. Don't let emotions override your strategy. The historical perspective, let me give you some historical perspective. The U.S. stock market has crashed many times. In 1929, during the Great Depression. In 1974, during an oil crisis and recession. In 1987, when the market fell 22% in one day. In 2000, when the dot-com bubble burst. In 2008, during the financial crisis. In 2020, during the COVID pandemic. Every single time people said, this time is different. This time, the market won't recover. Every single time they were wrong. The market always recovered and went on to reach new highs. Why? Because the market represents businesses, and good businesses find ways to adapt and grow. The American economy is incredibly resilient. It has survived wars, depressions, pandemics, and crises. It will survive the next crash too. My personal experience, I bought my first stock when I was 11 years old. I've been investing for over 70 years. I've made many mistakes, and I've learned from all of them. The biggest lesson I've learned is this time in the market beats timing the market. You don't need to be smart to be a successful investor. You need to be disciplined and patient. You need to control your emotions. You need to think long term. These are skills anyone can develop. I'm not special. I didn't inherit money. I didn't get lucky. I simply followed basic principles consistently for a very long time. You can do the same thing. I'm taking action now, so here's what you should do today. Start building your cash reserve. Open a brokerage account if you don't have one. Educate yourself about investing. Make a list of companies you'd like to own or decide to invest in index funds. Write down your investment plan. Then, when the next crash comes, whether it's in 2026 or any other year, you'll be ready. While everyone else is panicking and selling, you'll be calmly buying. While everyone else is losing money, you'll be positioning yourself to get rich. The final word, remember, a market crash is not a disaster. It's a transfer of wealth. Wealth moves from the panicky and impatient to the calm and patient. Wealth moves from those who sell in fear to those who buy with courage. Wealth moves from those who think short term to those who think long term. The next crash will create millionaires. The question is, will you be one of them? The choice is yours. Start preparing today. And when opportunity comes knocking during the next crash, you'll be ready to answer the door. I've built my fortune by being greedy when others are fearful. I've bought great businesses at discount prices during times of panic. I've held them patiently while they recovered and grew. This strategy has made me one of the wealthiest people in the world, and it can help you build real wealth too. The beauty of this strategy is that it's simple. You don't need to be a genius. You don't need fancy computer programs or complex formulas. You just need disciplined patience and the courage to act when others are afraid. So get ready. The next opportunity is coming. And when it does, I hope you'll remember these words and have the courage to take action. That's how you turn a market crash into the opportunity of a lifetime. Good luck and happy investing.